Hello everyone, my name is Toon, the Chief Investment Officer of Asia Pacific Equities at RHB Asset Management. Welcome to another episode of our podcast. Over the course of the last few weeks, the Chinese equity markets have been shaken by a series of news on potential regulatory curbs on a variety of industries. This has triggered a broader correction in the market. In this podcast, let's explore two key events that I think are of great significance to the market and our interpretation of the events. In the first instance, let's talk about the controversial IPO of Didi Global. News reports indicate that the Chinese regulators are considering serious, perhaps even unprecedented penalties for Didi Global after its controversial initial public offering in late June. It was speculated that Chinese regulators saw the ride-hailing giant's decision to go public despite pushback from the Cyberspace Administration of China as a challenge to Beijing's authority. Regulators are weighing a range of potential punishments, including a fine or suspension of certain operations. Also possible is a forced delisting or withdrawal of Didi's US shares, although it's unclear how such an option would play out. Deliberations are at a preliminary stage right now, and the outcomes are far from certain. It is interesting to note that the largest shareholder of Didi is SoftBank and the second largest shareholder is Uber, which are obviously not China-related entities. Our view is that these regulatory actions appear to be targeted at Didi specifically and not the ride-hailing industry in general. This is evident from Meituan making its Meituan Dache app available in Android App Store shortly after the regulators clamped down on Didi. As at 12 July, based on news report, Meituan Dache is now available to users in over 100 cities, including Beijing, after Meituan stopped the app 2 years ago in order to control costs. From the Didi's incident, it would appear that Beijing is sensitive about certain key industries listing on foreign exchanges, especially those that may have cybersecurity implications on China. However, we note that there will be Hong Kong or China-listed stocks that are well placed to take advantage of such a change in listing destinations of new Chinese IPOs, especially if the preferred choice of listing is Hong Kong or China. Now, for the second key event, in late July 2021, China's State Council announced the end of for-profit after-school tuition in China. The key surprises for the market include the following. 1. Academic tutoring institutions must register as non-profit institutions. 2. After-school tuition is banned on weekends, summer, winter, and national holidays. 3. Foreign capital must not be invested in academic tutoring institutions. We believe the crackdown on education is an industry-specific regulatory effort, despite the fact that the China internet sector is also undergoing regulatory scrutiny currently, which we believe is a separate issue. This crackdown on the Chinese education sector is aimed at trying to curb soaring educational costs, which is believed to have resulted in declining birth rates and to reduce overall academic pressures on Chinese students. We note that this recent move has been well received by the Chinese people in general. Obviously, the recent mounting uncertainties on the regulatory front are leading to significant volatility in Chinese stocks. In general, the recent slew of regulatory changes aim to address regulatory loopholes to ensure fair competition and sustainable growth. In fact, these regulatory rules in China are no different from the antitrust investigations and the consumer data protection efforts in US and Europe. The only main difference is that in China, the timeline for action is very much accelerated and compressed, in line with the centrally planned economy of China. What is happening now is that the grey areas in rules and regulations that have historically been used to tolerate regulatory inconsistency or ambiguity are now being removed or clarified in no uncertain terms. These changes will no doubt affect the existing business models of Chinese companies. However, overall, these changes are positive and will eventually have happened anyway, just an issue of sooner or later. These changes aim to level the playing field and clarify on rules, and should not be interpreted as governmental crackdown on private companies. The importance of private companies on the Chinese economy has been well proven by China's developmental path over the past 3 to 4 decades, and should remain the case going forward. We believe that understanding the long-term goals of the regulators is key to the interpretation of the recent regulatory changes. Recent regulatory interventions fall broadly into 3 main objectives of control, equity or fairness, and society goals. Understanding these objectives will help us navigate these uncertain times. While we think that the ongoing regulatory changes will probably continue and may not end so soon, it is important to acknowledge that these changes are positive from the long-term development agenda and are aligned to the interests of the masses. It is also important to differentiate between sectors and companies that are in different phases of this regulatory scrutiny. Some companies which were under the microscope earlier, especially if there were already fines levied or remedial actions implemented by regulators, will probably exit this investigation phase sooner than others that were only recently implicated. More importantly, Chinese companies that are able to adapt and evolve in this new regulatory environment will in fact prosper under this more clearly defined framework, which is endorsed by the Chinese authorities. With that, we have come to the end of our podcast. Hope everyone stays safe and healthy in your daily lives and in the market as well. Thank you very much for your time.